Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Victor Adair, co-founder of the Polar Futures Group. He's Senior Vice President and Derivatives Portfolio Manager at PI Financial in Vancouver. His website, polarfuturesgroup.com. Welcome back to the show, Victor.
Jim, good to be back with you. Lots going on.
Victor, the attacks on oil processing facilities in Saudi Arabia this past weekend caused a sharp jump in oil prices. How would you describe the market action since those attacks?
I'd say the market action was, on one hand, was rather dramatic, and on the other hand, maybe much less dramatic than you might have expected. And I'll put it this way. I mean, the attacks happened on the Saturday. The major markets opened Sunday afternoon, Vancouver time, and sort of right off the opening, crude oil, that's WTI that we trade in New York, was up about $8 a barrel to $63 or so. Reflecting, let's call it, the risk premium that was in the market, the concerns that there might be more attacks or there might be retaliation, that sort of thing, and also reflecting that, hey, we've just lost 5% of the global daily amount of oil that's consumed. That's got to be bullish for prices. Interestingly enough, what's really happened since then, I think, what did I say, we hit $63. We're now trading on the front month at about $58. So we jumped $8. We're now $5 back from that. One of the reasons, I suppose, that that's happened is that, there has been no more attacks. There has been no more retaliation, although there's certainly been some saber rattling. And the Saudi authorities have come out and, in my simple language, said it's not as bad as we thought in terms of our ability to deliver future production. We're making repairs and so on. So, it's really scaled back on that side. We had that panic high, and it was interesting looking at some other markets. For instance, gold. Now, I'd say, 20 years ago, if this would have happened, the gold market would have gone bananas. As it was, by the way, on like Sunday, Saturday afternoon, people were talking about the possibility of $100 oil because of this. There's always that hyperbole out there. But gold actually had a fairly subdued rally on this, the trouble in the Middle East story. It did jump $20-25, I guess, Sunday afternoon into Monday morning, but, settled back, gave up a lot of those gains before, and we'll talk about the Fed later, before the Fed came along. The stock market also didn't get scared, we got the S&P, the Dow, that sort of thing, near all-time highs, backed up a little bit, but really tiny compared to, what you might have imagined. So the uncertainty, I guess, about the source of the attacks, some people seem to be more certain than others about where it came from, but there's certainly lots of talk out there about, who done it. So far, a very measured response from the Saudis in particular. And then there's the aspect of the United States, and particularly, call it North America, self-sufficient in oil. So, so what? They have a problem over there, can't deliver into the world market. We're fine. Any number of things, but, that was the actual market reaction in terms of price. And, I think another thing was, we've seen the price of oil kind of struggle this year. Certainly had a sharp fall last October, November, December. A rally back up, got back to $75 or so here a couple of months ago. But oil, I think, has been struggling a bit, and I would imagine that producers of oil might have seen an $8 rally as a gift, and they sold into it.
Of course, the skeptic in us could even say, what if the Saudis set fire to their own plant and blame somebody because it would increase oil prices?
Sure. As I say, it seems at this point to be uncertain. Okay. And that's a polite word for all that skepticism you're talking about, about who did it, who done it. Maybe we'll never know. What we do know is, there was some damage done to their processing facilities by some sort of explosive device that apparently came from someplace else. Interesting thing, though, was nobody was hurt. You go, really? There's a lot of odd things about it, so I think there's some questions that we'll see. The Secretary of State, Pompeo, has arrived in Saudi today. I think the first thing he said when he got off the plane is it was an act of war by Iran. So, he's doing his saber rattling. We'll see where it goes from here.
The Fed did cut interest rates as expected today. Was it as much as expected or just the right amount to what people were speculating it would be?
Yeah, well, this has been another greatly anticipated Federal Reserve meeting. And as you say, going into the meeting, the market was almost fully expecting that the Fed would cut a quarter point, and that's what they did. You go back to the Fed's mandate to maximize employment and produce stable prices, and maybe a mandate to moderate long-term interest rates. And I think Powell, in particular, or the Powell Fed, say, wants to extend the current economic expansion that we've been on, and in some respects that means keeping confidence high. And one of the ways to keep confidence high, of course, is to keep the stock market up. Interesting to see that the FOMC was not unanimous, that there were 3 dissents there, and for the going forward in terms of more cuts, there seemed to be 7 people in favor and 5 against. So, the Fed itself not monolithic, and everybody's got their views. What happened following the Fed announcement is the stock market was a little softer. The bond market, not much changed. The U.S. dollar was stronger against virtually everything. And gold down about, I think we dropped actually $30 from the highs today to the lows today, as, the prospect of, let's say, the Fed not being keen to crank up the printing press, again to use, rough language, was not good news for the gold market. And also, and we can talk more about gold later, but I think that the gold market has been run up here, maybe a little bit on hopes, and if the hopes aren't fulfilled, then, gold could back up a bit. I saw a wonderful interview, yesterday with, Danielle DiMartino Booth talking to Keith McCulloch at, Hedgeye. And she characterized Powell as a bit of a bond vigilante. Said, he, in his heart, he doesn't want to go back to QE. And I remember when Powell became the head of the Fed, I was saying it's going to be a different Fed under Powell. This is not Bernanke. This is not Greenspan. This is certainly not Yellen. This is a more pragmatic business guy, maybe a little more tougher. And, as time went by, I kind of thought, gee, maybe I have to eat those words. Maybe he is going to cave, at the first sign of trouble. And of course, he's got Trump tweeting at him like an idiot. Anyhow, I kind of saw that in Powell today. I think he really is a bit of a bond market vigilante, and he really doesn't want to take go back to QE, certainly in a big way. Now, there are folks out there, and Daniel DiMartino Booth would be one of them, and so Keith McCulloch at Hedgeye, who think there is a recession coming down the tracks just like a freight train, and that the Fed is going to have to acknowledge this and really have to cut rates. Well, there's other people out there, the economists, who think, no, that's not the case. So that is, I think, reflected, these divergent views, in the fact that the vote by the FOMC today was not unanimous, and the best they can do, like the rest of us, is kind of look at the data as we go along. We are seeing some signs that things are slowing. Heavy truck production in the United States is really slowing. Truck drivers getting laid off. You see what happened to FedEx today. The stock's down I'm looking at my quote board here, $24 here. It was about a 15% haircut on their stock when they're forecasting, looking ahead forward guidance saying things don't look all that rosy. And then there's other sectors or segments of the economy that do look better. Anyway, right now, the Fed did what they were expected. The market's pricing in sort of a 50-50 chance of another cut this year, but we'll see what happens as the data comes down the pipe.
Powell said that he does not foresee negative interest rates. Is that good news for the financial sector in North America?
I think what he said, and you're very close, that when they were in the great financial crisis, okay, and trying to work their way out of that 08, 09, they did take rates down to 0 or thereabouts. They looked at negative rates, but decided against that and went for QE instead. In other words, asset purchases. And he thought that was the better choice. Devil in the deep blue sea, but that's what he said. The Federal Reserve under his leadership, and Daniel DiMartino Booth was saying yesterday he doesn't want to go to QE. I think he sees a lot of problems. There'd be people that say once you go, cross the Rubicon and you're into negative interest rate land, there's no coming back. Everything just goes to hell in a handbasket after that. So I kind of agree with him, but again, we'll see what happens as we go forward.
We'll have more with Victor Adair right after the break.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the 2019 drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Grand Portage Resources' Herbert Gold Project in southeast Alaska highlights increased gold resource, indicated and inferred, of 860,000 ounces, in excess of 10 grams per ton gold. Expansion drilling is planned on the Herbert Gold property for the summer of 2019. Grand Portage Resources trading symbols are GPG on the TSX Venture, GPTRF on the OTCQB, and GPB on Frankfurt. For more information, please visit our website, grandportage.com.
Welcome back. We're speaking with Victor Adair. Victor, for the past 2 years or so during these interviews, you've been consistently bullish on the U.S. dollar. Is that still the case?
Short answer is yes. And my rationale on that, let's call it the big picture view, is that capital comes to the United States from the rest of the world, or comes back to the United States after being outside, for safety and for opportunity. You have freedom relative to a lot of other places in the world. You got rule of law, again, relative to other places in the world. So capital comes to USA in that kind of an environment. And like the reciprocal of that is, or the other side of it, is that capital goes away from the United States when the market's feeling frisky. Everybody's in a pretty good mood, and maybe making 8 or 9% return on your money is just not sexy enough, and you can go invest in some emerging market somewhere with the promise of making 17. So capital go away. When you kind of are more interested in the return of your money than the return on your money, that kind of thing, the United States looks pretty good. The U.S. dollar index, and that's heavily weighted to the euro with a little Canadian and a little Japanese thrown in, has been trending higher for the last year and a half. It hit a 28-month high about 2 weeks or so ago. The trade-weighted dollar, which takes in, a much broader selection of countries around the world, and is just what it says. It's weighted against the people that the countries that the United States does business with, is at an all-time high. The U.S. dollar here, that within the last week or two, touched an 11-year high against the Chinese RMB, a 10-year high against the Australian dollar. So that's what I've called the stealth strength of the U.S. dollar. In Canada, obviously, we see Canada against the U.S. dollar. The Europeans see the euro, and so on. And just generally in the world, we look at things like the U.S. dollar index. Then you see the dollar stronger, but not raging ahead, but then against some emerging market currencies, and the outliers like Iran or Argentina, just leave them aside, where the currency, or Venezuela, where the currency just cratered. But just broadly speaking, the U.S. dollar has really been strong like Big Bull against emerging market countries. So I'm generally remaining friendly to the U.S. dollar. It's not a runaway bull market in terms of just going straight up at all. It's been choppy. It's maybe difficult to trade, but I still think the U.S. dollar is going to trend higher.
Gold has jumped about $250 or so, or about 20% since May. Do you think, why has that happened? And do you think it's going to keep going higher?
Yes, you're right. Since May, we're up about $250, as you say, or 20%. I think the key reason has been the declining interest rates, especially declining real interest rates. There's usually, sort of three big reasons why the price of gold expressed in U.S. dollars goes up. One is the U.S. dollar is weak. The other is negative or low interest rates. And then the third is geopolitical stress. Something like what happened here with the attacks on Iran, on Saudi. Over the years, those geopolitical events usually give gold a spike, but it sets back from that. So recently, as I've just said, we've seen the U.S. dollar strong and gold's up against the U.S. dollar in that environment. Gold's at all-time highs against a number of currencies other than the U.S. dollar. So gold, I think, rallying, even though the U.S. dollar has rallied, kind of points the finger, if you want to know why. You see these correlation charts between the price of gold and the amount of negative yielding bonds outstanding. And then, it's a pretty tight fit here in the last year or so. And there's another factor too, and I'm going to call it momentum, for lack of a better term. A year ago at this time, the speculators on the COMEX futures market, the gold people generally refer to as the paper gold market, the speculators there were net short gold for the first time in 10 years. Now, they're about the net longest or the most bullish on gold that they've ever been. So, gold was really out of favor a year ago, and then as the market had the rally, no matter what it is, when something is moving up, like gold has moved up since May, it attracts attention, like, the moths to a flame and all that kind of thing, and people come to it. And there's been lots of good reasons to buy gold. So why has it been going up? I think very much it's been the real interest rates. It has been a safe haven bid in a world that's looking for safe havens. The gold has gone up as bonds have gone up. But if there was one real key thing, I think it's been this real decline in real interest rates that have put a bid into the gold. Now, today, we've had gold weaken when, say, not given everything they wanted from the Fed. And with all of these people long gold, I think there's some real risk that if we have some event or something triggers a little bit of a sell-off, that it could snowball a bit to the downside, because a lot of people may go, yikes, this isn't working. I thought it was a guarantee. And they might have to cut their positions. But I'd be inclined to think we've seen the low in gold, and it'll probably be headed higher as we go forward.
We'll have more with Victor Adair right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Victor Adair, Victor, the S&P 500 index is near all-time highs, even though it's had some sharp corrections over the past couple of years. Do you think it keeps going higher?
I guess the answer is yes. And boy, oh boy, I'll trade it from both sides. But the major share indices, okay, this is like, let's call it the S&P 500. Let's go with that. I mean, we've had incredible momentum. It's been rising since 1982, as interest rates have been falling, broadly speaking, since 1982. And then there's TINA. There is no alternative in a world of ultra-low interest rates. And you've got, whether it's people that are managing their own money or people that are managing pension funds on behalf of other people, you're looking around, you've got to get, you figure you've got to get a certain rate of return. And if you're getting pretty much next to nothing by being invested in, call it routine credit markets, you look around and say, well, maybe we have to be in the stock market. Now, on the risk side, certainly if there is a recession coming, then that's going to impact the earnings that companies have, and certainly one of the major forces in the bullish forces the last few years in the stock market has been corporate buybacks, and those buybacks are largely fueled by cash flow. In other words, they've got the earnings, they're making the money, and they can take that money and buy their own stock back with it. There's also some borrowing money to buy back stocks, but if there was a real decline, I call it an earnings recession, that would be a real risk for the stock market. You could see stock market set back. You talk about, these, call it choppiness. No, let's call them scary corrections, particularly the one we had last, October, November, December. I think, everybody that's participating in the market has a sense that it's highly levered. It's vulnerable to, a bit of a short-term stampede. And so, to use a term from, Freddie Prinze a few years ago, he said, when the music's playing, you gotta keep dancing. So, I think people have a sense that other people, including themselves, want to be dancing close to the exits, just in case one of these sharp breaks comes along and you can reposition yourself or jump out of the market. So I would think going forward, yeah, we probably go higher, but I think the ride could be rocky.
WTI crude oil is now around $60 a barrel. Last year it hit a high of around $75 in October before plummeting to $42 in December. You previously talked about how crude prices often move in sync with the stock market, yet we have the stock market near all-time highs, but crude is very short of even last year's high. Why do you think that's happening?
Yeah, that's an interesting question, and I have seen WTI in particular be very correlated with the S&P 500 from time to time. It seems to me it's more correlated when they're both going down together, and sometimes when the market is more just again to exaggerate, but when the market's more panic-driven or fear-driven, then correlations go to 1. When the market's more, it's just another normal day in the neighborhood, then the different markets react to the fundamentals that affect that particular market. So specifically the WTI, I think the media has been mostly focused on supply stories. Okay, there's the cutbacks by OPEC and friends as they're trying to manage supply relative to demand. We've got another supply story. We've got rising American production. And then, of course, one of the first things that comes to mind here this past weekend when they had the attacks on the Saudi processing facilities was there goes a big important chunk of supply. But when we look at the global picture from the economy is slowing point of view, then how about demand? And what we're seeing is these various international organizations that make these forecasts keep scaling back their forecast for how much demand is going to grow. So when we talked about crude earlier, and I was saying, you have producers who might have seen an $8 jump in crude as a great opportunity to sell, I think that definitely was there. If you're a producer and at roughly $60, you're not making much money, so your margins are kind of skinny. If you can lock in an $8 bump from where prices were yesterday, sold. And then we had, the talk, let's call it, of $100 oil immediately when we had this attack on Saudi Arabia. Well, it certainly didn't happen. Markets got bid, and almost just as quick as they were bid, prices came back down again. So I think that correlation with the S&P between WTI and S&P is going to be stronger when the markets are going down, and less so when we're going up. And I think that the real reason that we're not seeing WTI go up to the same degree that the S&P has, let's say, since for the past few months, has maybe been this focus on how about the demand side, and the demand looks like it's weakening because of slowing global growth.
Is weakness in crude one of the reasons why the Canadian dollar is stuck around 75 cents U.S.?
Short answer, yes, sure. I think if we saw Sunday night, just short, real quick little picture there. I mean, the Canadian dollar was bid when crude oil was up $8. So that's kind of the knee-jerk reaction. As we've talked on the show before, when we're looking at Canada and why Canada is up or down against the U.S. dollar, we've got the equation's pretty much four variables. One is how's the U.S. dollar, or the big dollar, as they call it in the FX market, how's it doing? If the U.S. dollar is weak against everything, it's weak against Canada, and vice versa. Commodities, especially crude oil, is a big variable in the value of the Canadian dollar, particularly over, longer chunks of time, like, quarterly, that sort of thing. Relative interest rates. And right now, that's been kind of a favor for Canada. We've come back to a time here when our interest rate differentials are closer for the past year and so, and the advantage has been very much to the United States. And then from time to time, we have other factors. Remember when NAFTA was being thrashed around as the Americans and Mexicans and Canadians were trying to work out a deal, and things weren't going well. That put some pressure on Canada. But then to think in terms of Canada as being weak, that's just when we look at Canada against the U.S. dollar. Actually, Canada is one of the strongest currencies in the world. We're at a 10-year high. Relative to the Australian dollar, and about the same, relative to the Chinese RMB. And as a matter of fact, Canada, I guess, is stronger against this year all of the European currencies, the emerging market currencies, and then I think the only thing, the significant currencies anyway, that Canada's weaker against is the U.S. dollar and the Japanese yen. So one of the aspects there is, maybe a good way to wrap this all up, is as money comes to the United States, I think some of it might see, hey, there's Canada right beside States. Well, let's put some money into Canada. Our Canadian dollar is at a 10-year high against the Australian dollar for a number of reasons. But if you wanted to cook it down, we're next to the States, they're next to China, and there you go. That's the difference.
Anything else you wanted to add to today's show, Victor?
Not really, Jim, other than to say, it seems to me if you're participating in these markets, you just need to be prepared for volatility. I think we're getting knocked around by this and that, and, anytime you start to get a little complacent about things, you probably due for a surprise. So, yeah, if you're trading, what that probably means is, definitely, have a plan for what you're going to do if your latest brainwave isn't working out. In other words, have an exit strategy. Keep your size maybe a little more modest than you might otherwise. I think. I took a short position in gold on Friday of last week, and I'll tell you what: if I had to do it again, I would do it, given the information I had at that time. It looked like gold was closing at about the lowest level it had closed in a month. I felt that the market was overbought. There was some vulnerability to the thing setting back, and I thought it was a good trade. I didn't see the missiles coming on Saturday, and all of a sudden gold's $20-odd or $30 higher, and I go, oh boy, So, I mean, I did wait it out a bit. I was surprised that it wasn't $100 higher, and I had limited my risk by buying puts instead of just being outright short. But, there you go. It was just one of those things you don't see coming, and you can't see it coming because it's in the future. But if you're trading, you got to be prepared to be wrong and know what you're going to do if that happens. So that is if you want to survive. If you're just in there gambling and it's entertainment, well, that's a different story.
Victor, thank you so much for being on the show.
Jim, it's always a pleasure to talk to you. Thank you for having me.
My guest has been Victor Adair, co-founder of the Polar Futures Group. His website, polarfuturesgroup.com. If you have any questions for Victor or any of our other guests, you can send them to info@howstreet.com. Find us on Twitter @HowStreet, our YouTube channel, Talk Digital Network. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.